welcome to the deep dive. In a world absolutely swimming in information, especially when you're trying to make sense of financial markets, finding clarity, finding those really actionable insights, it can feel impossible sometimes, like grabbing smoke. But what if there were tools honed over, well, centuries actually, that could help us cut through that noise, help us find the real pulse of the data? Today we're doing a deep dive into one of those, the weighted moving average, or WMA. And it's more than just some line on a chart. It's a fascinating example of how experts keep refining things to get closer to what's really happening.
Exactly. And our mission today really is to give you that shortcut, to get you properly informed about WMA, quickly but thoroughly. We'll look at where it came from, how you actually use it, get into the details, the nuances, and see how it fits into the bigger picture of market analysis. We're aiming for those aha moments, so you walk away really getting it.
Okay, so to really get the WMA, we kind of have to start with its family tree, right? Moving averages, MAs, they're foundational, some of the oldest, most widely used tools in finance. And the roots go way back. We're talking, believe it or not, 18th century Japanese rice traders, just intuitively smoothing out prices to spot the trends. Then, fast forward early 20th century, modern MAs start appearing. And one of the first big ones was the simple moving average, the SMA. Super popular because, well, simple. But it has this one big drawback, its key limitation, really. The SMA treats all the data points the same, equal weight. What was the problem with that equal weighting? Why do we need something like the WMA?
That's the perfect question. Because that equal weight is precisely the issue the WMA was born to solve. Think about it. If today's price matters just as much as the price from, say, 3 weeks ago, well, that creates lag. Significant lag. The SMA just reacts really slowly to what's happening now. So the WMA came along as part of this evolution, along with things like the exponential moving average, the EMA, all trying to be more sensitive to recent price action. WMA specifically gives more weight to the newest data, and then that weight drops off linearly for the older points. It's hard to name one single inventor for the standard WMA we use today. It kind of developed gradually. But that idea, the idea of different weights, that really took hold mid-20th century, a clear step forward.
Okay, we get the history, the why.
Yeah.
But what's the WMA's actual job on a chart? What's its superpower for a trader dealing with all that market noise?
Right. Its core job is smoothing. It filters out that short-term chop, the random fluctuations, the noise. And by doing that, it helps you see the underlying trend more clearly, much more clearly. And its key differentiator, its superpower, if you like, is that linear weighting. Prioritizing recent prices makes it react way faster than the SMA to new information, which makes it super flexible. You see it used a lot in different markets, but it's especially popular in Forex, partly because of that responsiveness.
And it gets used in so many ways. So for you listening, here's how that translates practically. First, identifying trend direction and strength. Just look at the slope of the WMA line. Is it pointing up? Is price staying above it? That suggests a solid uptrend. Second, generating trading signals, the classic stuff.
Yeah.
Price crossing over the WMA, or maybe two WMAs crossing each other, a faster one crossing a slower one. People call those golden crosses or death crosses. Signals potential shifts. Third, it acts like dynamic support and resistance. In a trend, you'll often see price pull back, touch the WMA, and then bounce off. It's like a moving floor or ceiling. Fourth, the big one, filtering noise and cutting down that lag compared to the SMA, so you react quicker. Fifth, you can even use it to gauge volatility or momentum. How far is price from the WMA? How steep is the WMA slope? And finally, it's often just one piece of a bigger puzzle. You combine it with other indicators, RSI, MACD, Bollinger Bands, to build a more robust strategy.
Exactly. It really strikes a balance, It's smoother than something like an EMA, generally speaking.
Yeah.
But it's definitely faster, less laggy than the good old SMA. It kind of finds that middle ground.
All right, let's get under the hood a bit. We keep saying weighted average, but how does that actually work? Can we break down the math simply?
We absolutely can. The core idea is simple. Give more importance, more weight to the recent stuff. So with the linear weighting of WMA, the very latest price gets the highest weight. That weight is just the period length, Eamon. So if you're using a 5-period WMA, the last price gets a weight of 5. The price before that gets a weight of N1, so 4 in our example. Then 3, then 2. All the way down to the oldest price in that period, which gets a weight of just 1. Then you need the denominator, the bottom part of the fraction. That's just the sum of all those weights, 1 plus 2 plus 3, up to n. And there's a neat little formula for that. N times n plus 1 divided by 2. Saves you adding them all up every time.
Okay, let's make that concrete. Numbers help. Say we want a 5-day WMA, and let's say the last 5 closing prices were Newest first. 38, 24, 21, 12, and 10. So the weights are 5 for the 38, 4 for the 24, 3 for the 21, 2 for the 12, and 1 for the 10.
Oh, exactly.
Okay. Sum of weights. 5 plus 4 plus 3 plus 2 plus 1. That's 15. Now the top part, the numerator. Multiply each price by its weight. 38 times 5 plus 24 times 4 plus 21 times 3 plus 12 times 2 plus 10 times 1. Let's see. 190 plus 63 plus 63 plus 24 plus 10. Okay, that adds up to 383. So the WMA is 383 divided by 15, which is around 25.53.
Precisely. And that calculation isn't just a one-time thing.
Right, it keeps moving. Each new day or bar or whatever period you're using, you drop the oldest price, add the newest one, recalculate, and plot the new point. That's how you get that continuous WMA line on the chart, constantly updating.
Now, here's something really important, especially for you, the learner, thinking about applying this. WMA, like other moving averages, has underlying assumptions. It assumes past data is useful, which is fair, but it is still lagging. It shows what did happen, not necessarily what will happen. And its core assumption is that recent data is more relevant. That's the whole point of the weighting. But here's where it gets interesting, especially if you use it for things like estimating risk or variance. WMA implicitly assumes the market noise or randomness is, well, consistent, identically distributed, independently distributed. It assumes homoscedasticity, constant variance over time.
Which real markets often aren't, right? We see volatility clustering, big moves followed by big moves.
Exactly. Real financial markets often show heteroscedasticity, the variance changes. Quiet periods, volatile periods. If you ignore that, your WMA-based risk estimates might be off. Sometimes way off. It's a crucial limitation to keep in mind.
Okay, that's a really important nuance. So given that, what's the main knob a trader needs to turn to tune the WMA, the key parameter?
Without a doubt, it's the period length, that one we used in the calculation. This completely changes how the WMA behaves. Use a small in like 5 or 9 or maybe 20 and you get a faster reaction, less lag. Good stuff. But the downside is it's much more sensitive to noise. You get more whipsaws.
Whipsaws, those annoying false signals that get you in and out of trades for no good reason.
Precisely. So shorter periods are often favored for short-term trading, like day trading or scalping, where you need that speed.
Okay, and the flip side, a large N, like 50, 100, 200.
A large N gives you a much smoother line. It filters out more noise, which is great for seeing the bigger picture, the longer-term trend, but the trade-off is more lag. It will react much more slowly to recent price changes. So longer periods are generally better suited for long-term trend identification, maybe swing trading or position trading.
So how do you find the right N? And it sounds like a bit of a balancing act.
It absolutely is. And the right end depends entirely on your trading goals, your time frame, the market you're trading. There's no magic number. The best approach: backtesting. You try out different end values on historical data, see how they would have performed. Look at things like profit, drawdown, win rate. But here's a pro tip. Don't just backtest. Use walk-forward optimization or WFO.
Walk forward. How's that different?
It helps prevent over-optimization or curve fitting. That's where you find parameters that look amazing on your past data, but completely fall apart the moment you use them live. WFO works by optimizing on one chunk of historical data, then testing those parameters on the next, unseen chunk of data. Then you repeat. It gives you a much more realistic idea of whether your chosen N is actually robust and likely to work going forward.
That makes sense. So no shortcuts. Careful testing and validation are key. All right, let's bring it all together. WMA in action. Strengths first. Clearly, it's faster, less lag than SMA. Big plus. It's good at smoothing data, filtering out the chop. Offers that nice balance we talked about between SMA's smoothness and EMA's sometimes hypersensitivity. And it's relatively easy to grasp, concept-wise, and pretty adaptable.
True. But let's talk weaknesses, because they're just as important. Because it's faster, it is more sensitive to noise, more prone to those whipsaws, especially when the market isn't trending strongly. Sideways markets are tough. It's still a lagging indicator. Remember, it's based purely on past prices. Less effective, as I said, in ranging or non-trending markets. It needs a trend to follow. Sudden, sharp price spikes can knock it around a bit. And as we just discussed, that period length needs careful optimization. It's not plug and play.
Yeah, the sensitivity seems like it's double-edged sword. Faster reaction is great until the market goes sideways and it just generates noise.
Yeah.
So when does it really perform well? Where does it shine?
It really shines in clearly trending markets. No doubt about it. The slope confirms the trend, the line acts as that dynamic support or resistance. It's beautiful to watch sometimes. It's also great for short to medium term trading, scalping, day trading, swing trading styles that benefit from quicker signals. It can help spot early momentum shifts potentially sooner than an SMA. And in markets that are volatile but still directional, its responsiveness can be a real advantage.
And the opposite. When should you be wary of relying too heavily on WMA?
Be very wary in sideways or ranging markets. It'll likely just chop you up with false signals. No clear trend means no clear signal from the WMA. Also, in very choppy markets with high random volatility, not directional volatility, just chaos, its sensitivity becomes a major drawback. It amplifies the noise. And maybe the most important point, it generally performs poorly when used completely alone. It really needs confirmation.
Okay, confirmation is key. So how do people actually use it day to day? Give us some real-world examples. Well, in Forex, for instance, you might see traders using WMA crossovers. A faster WMA, say the 20 period, crossing above a slower one like the 50 period, as a potential buy signal. Or they might use a single WMA, maybe a 21 period, to look for pullback entries. Price is trending up, pulls back to touch the WMA 21, then bounces. That could be an entry point. For stocks, long-term folks might put a WMA 100 or 200 on a weekly chart to gauge the major trend. While a scalper might use a very short WMA, like a 5 or 9 on a 1-minute chart, probably combined with something like RSI or stochastics to avoid buying tops or selling bottoms. You also see it in commodities, portfolio management. It's versatile.
Absolutely. And this is really crucial based on our source material, we need to be clear. The sources don't provide specific hard data or detailed case studies proving that use WMA this way and you'll make X%. It underscores the point that you, the listener, must do your own rigorous backtesting and optimization. WMA is a fantastic tool, a component. It's not a ready-made, profitable trading system right out of the box. Its value depends entirely on how you integrate it.
That's a vital reality check. Okay, let's put WMA side by side with its cousins. WMA versus the SMA, the simple moving average. Quick comparison.
Easy one. Weighting. WMA weights linearly by recency, SMA weights equally. Reaction lag. WMA is faster, less lag. SMA is slower, more lag. Noise signals. WMA is more sensitive, more prone to whipsaws. SMA is smoother, fewer false signals, but later signals.
Got it. Now, WMA versus the exponential moving average, EMA, they both prioritize recent data, right?
They do, but differently. EMA uses exponential weighting. Usually, this makes old data fade away even faster than WMA's linear weighting. Also, EMA technically considers all past data in its calculation, though the older stuff has tiny weight. WMA strictly uses only the end periods you set. Reaction lag. EMA is generally seen as even faster than WMA, less lag again. Noise signals. Because it's faster, EMA can be even more sensitive to noise than WMA, potentially more whipsaws. WMA, again, often seen as that balance point between SMA's steadiness and EMA's speed.
Okay, and then there's a different beast. The volume-weighted moving average, VWMA. How does that fit in?
Completely different weighting principle. WMA weights by time, how recent is the price. VWMA weights by trading volume that occurred at each price.
So it cares about where the actual heavy trading happened.
Exactly. VWMA highlights prices where lots of shares or contracts changed hands, which some traders see as more significant or fair prices. WMA is looking purely at the time-based trend. VWMA is looking at the price levels validated by activity. So application-wise, WMA is pretty universal. VWMA is really only useful where you have reliable volume data, think stocks, futures. Less useful in decentralized markets like spot Forex.
Right. So it's like having a toolkit. SMA for smoothness, EMA for speed, WMA for balance, and VWMA for volume context. You pick the right one for the job.
That's the perfect way to think about it. No single average is inherently the best. It completely depends on your specific strategy, your time frame, the market you're watching, and how much you value responsiveness versus signal clarity. WMA sits nicely in the middle of the time-based averages, offering that clear, linear approach to weighting.
Okay, this has been a fantastic deep dive. We've seen the WMA isn't just a line, it's a really smart, balanced tool. Great for spotting trends, generating signals, all thanks to that clever weighting.
Yeah, absolutely. And for you listening to really make it work effectively, remember those key takeaways. First, optimize in rigorously, backtest, and definitely use walk-forward optimization to build confidence it'll work out of sample. Second, and I can't stress this enough, don't use WMA alone, seriously. Always combine it with other confirming signals. Oscillators, MACD, price action, patterns, multiple time frames, get confirmation. Third, solid risk management is non-negotiable. You could even use the WMA itself to set dynamic stops, trailing them below a rising WMA, for example. And maybe consider market regime filters. Try to only deploy WMA strategies when the market is actually trending because that's where it's strongest.
So what does this all mean?
It leads to a final thought, doesn't it? If WMA was such a clever step up from the SMA, what comes next? Think about moving averages that could maybe adapt themselves, learn from market conditions, maybe using machine learning. Imagine an indicator that doesn't just react based on fixed rules, but intelligently adjust its own settings, and perhaps on the fly, almost anticipating shifts. Something to chew on. We definitely encourage you to keep exploring these tools, test them, adapt them, and see how they fit into your own approach to the markets.